If financial reports are merely shadows of reality, then maybe we can find a better angle that will allow us to cast a more informative shadow. In this video, we'll look at the most common alternative to absorption costing called variable costing. Neither system is perfect. They just leave us with different problems. So our choice comes down to this. Since neither system is perfect, which one creates problems that interfere the least with our ability to manage our organization? To understand the differences in the methods and in the problems they create, we'll need a clear understanding of double-entry bookkeeping. So let's return to our example of a t-shirt maker that prints t-shirts using a very expensive t-shirt printing machine, a fixed cost, and some labor and other resources that will be variable costs. Because the distinction between fixed and variable costs will be so important, let's set up two resource accounts, fixed resources of $100,000 and variable resources of $200,000. Splitting that account into two parts isn't essential to our reporting system, but it does allow me to show what's going on a little more clearly. We balance these resources with $300,000 of equity. Under absorption costing, our next entry would be to transfer $100,000 from resources into manufacturing overhead as the first step toward getting those costs into work in process. When we account for fixed costs this way, we're saying that our fixed costs remain an asset sitting on our balance sheet until we sell our inventory and they hit the income statement as cost of goods sold. But we don't need to do it that way. So let's reverse that entry and take a look at another way, called variable costing. Under variable costing, we transfer those fixed costs directly onto the income statement into what we'll call a fixed expenses account. When we do this, we're treating fixed costs as period costs, not as product costs. We're saying they're just a cost of operating during the period, and they aren't a cost of creating inventory. Instead, they're immediately treated as an expense, even if our inventory stays on the balance sheet. Every difference between variable and absorption costing stems from this one change. And it really makes things a lot simpler because now only our variable costs flow through manufacturing overhead. Just watch. As we make our first 15,000 units, we transfer $4 a shirt into manufacturing overhead. And we also apply $4 a shirt to work in process because there are no fixed costs to worry about. So look, even though we haven't yet produced the 20,000 shirts we projected, our manufacturing overhead account is still in balance because we've taken care of our fixed costs by transferring them all directly to the income statement. Now we make another 5,000 units to get to our projection, and naturally, we're still left with a zero balance in manufacturing overhead because we're incurring and applying the same amount. $4 a shirt for variable overhead. Now remember those three problems with absorption costing? The first was that absorption costing discourages managers from taking on work that would make our organization richer. And the second was that we encourage our managers to make goods they can't sell. Let's look at what happens when a manager is considering that extra job of 1,000 shirts that he'll sell at $7 a shirt. First, we set up those extra accounts, WIP X, cost of goods sold X, and revenue X. Now, as we make those shirts, we transfer $4,000 of variable costs into manufacturing overhead and $4,000 right back out again to WIP X. And, let's stop here for a moment. Remember, under absorption costing, making 1,000 shirts that we didn't sell increased our income. But look, that doesn't happen under variable costing. We don't have to touch the income statement at all because making those shirts didn't throw manufacturing overhead out of balance, so we don't have to adjust cost of goods sold. So we've solved the second problem of absorption costing because under variable costing, we're no longer encouraging managers to produce what they can't sell. Now, when we do sell those shirts for $7 each, we record revenue of $7,000, and we also record cost of goods sold at $4,000. So our income reported for this job is $3,000. That fits perfectly with the economics of production as laid out in our cost volume profit model. The contribution margin on each unit is the $7 of revenue minus the $4 of variable costs. So unit contribution margin, $3 a unit. Total contribution margin from this job, $3,000. So we've solved the first problem of absorption costing as well. If a job has a positive contribution margin, it will increase your income to take it on under variable costing. We've also solved the third problem with absorption costing. We aren't discouraging managers from using overhead drivers because we aren't using any drivers to apply fixed overhead. It's all falling directly to the income statement regardless of how much we produce. Variable costing sure is fantastic, isn't it? But now it's time for me to remind you that no system is perfect. Variable costing is no exception to that rule. The first problem is that now we might encourage our managers to settle for selling prices that are too low. Sure, taking on that job for $7 a shirt makes us richer than if we don't. But if we take all of our jobs for such a low price, we might not ever pull in enough contribution margin to cover all of our fixed costs. The second problem with variable costing is that treating fixed costs as period costs is more than a little misleading. Those fixed costs really are product costs. We incur them in order to provide our product or service. So we've understated the value of our inventory by not including those costs. If our inventory changes a lot over the period, then we'll misrepresent how much richer or poorer our organization really is. That's why, by the way, you can't use variable costing for external financial reporting or for tax reporting in most jurisdictions. Finally, variable costing is effectively letting managers use our fixed resources for free. So they might end up overusing them. If everyone starts using a lot of machine time, we're going to run out of capacity, which will cost us revenue, or we'll buy more capacity, which will be expensive. So again, no system is perfect. Both absorption costing and variable costing give us very useful reports, but they aren't perfect reports. The key for you is to understand what those imperfections are so you can avoid being misled.